Good evening, all of you. Welcome to the Hexaware conference call. The Safe Harbor statement is available on the Hexaware website, and I shall take that as read. From Hexaware, we have with us Mr. R. Sri Krishna, CEO and Executive Director, Mr. Ashok Harris, President, Global Delivery, and Mr. Rajesh Kanani, CFO. With this, I hand over to you, Keech. Thank you.
Good evening, everyone. We once again, for the second consecutive quarter, we were able to only send you the results not too much in advance of the call. But this time, at least, I can tell you why. And, we will be back to normal from next quarter. So we did have a change of auditor during the quarter, which is unusual. And the new auditor had to be approved by our shareholders today in the AGM that happened just 2 hours ago. So that's kind of the reason for all of this. Our earlier auditor was Price, and we had to change. So sorry about that. We will be back to kind of normal from next quarter. We had actually a very satisfying and robust start to the year. Our revenue growth, those of you that were there last quarter, I told you that we are likely to kind of have a lot of the growth coming in the middle of the year, especially because this year that's the way the calendar is. Q1 is a soft calendar. But we did a little better than that. Actually, we did better than the CQGR asked for the year in terms of growth for this quarter. So which then puts us in, solidly in line to do what we said we will do at the beginning of the year in terms of guidance. In terms of EBITDA, you will see flattish, slight drop. But, essentially what happened is that our gross margins were flat as a percentage, which means in absolute terms, they grew as much as the revenue did. But we reinvested all of that into SG&A, S&M more than GA. And we think that's good for us early in the year to make the investments because we anticipate a robust year. Finally, our PAT and EPS did exceptionally well, and we knew that as part of the planning for the quarter, so that allowed us to then spend a little more in S&M. We had guided that last quarter that we will have a net benefit due to the U.S. tax reform. So you're seeing that impact come through. So our EPS actually had a very robust growth of almost 11%. Again, note we have provided an EPS growth guidance for the year. Again, it puts us very solidly in line to meet that guidance. Those of you that are seeing the chart online, you will see a revenue analysis, Q&Q, a walk. But pretty much, the vast majority of the growth came from volume. 3.5% of the 3.9 came from volume, and there were two other factors, FX and Forex and bill rates, that constituted the rest. But the good news is that the vast majority came from volume growth. From a gross margin walk perspective, you will see, those of you that see the chart, you will see a mix of reds and greens. But the net effect of all of that is that the gross margin was flat. There was, little bit improvement on Forex, a little bit improvement on utilization. We had our usual H-1B visa filing fee this quarter. We will have the bigger chunk of the actual cost of H-1B coming in Q2, which will impact, but that's there every Q2. So there's no kind of change from a Y&Y perspective there. So while the gross margin was flat, we actually increased investment in SG&A roughly to the tune of 45 pips, which is actually the reduction in EBITDA that you see. Our top 20 customers, once again, there is a healthy churn. Again, there is nobody except the one client which insourced last year. There's no one else that's actually moved out as a result of revenue falling. But for the most part, it is because of accounts that were below growing faster that's coming up. I want to spend a minute or two on the client pyramid. We provided in the presentation a full year LTM view versus a previous LTM view. What you see, if you start at the bottom, is a lot of robustness in building up of the pyramid. And like especially robust, for example, is the 5 to 10 million. 6 accounts have gone to 10, and the 10 to 20 has gone from 3 accounts to 6. Of course, one of them was a 20 to 30 coming down, but the rest was accounts moving up. So we feel very good about how our portfolio and our pyramid is building up. What that means is that we are continuing to de-risk our portfolio. We are continuing to de-risk the concentration risk at the top. Now, some of it was not kind of planned or desirable, like the insourcing or the other account where we had a portion of revenues go away. But the net impact of all of that is that there is a nice de-risking happening at the top, and the next 5 accounts and the next 10 accounts continue to do better than company average. We had a good, robust quarter again from an NN perspective. I do want to call out the fact that this is a reduction from a sequential quarter perspective, but it's a growth from the same quarter last year perspective. It's a consistent enough pattern that Q1 from a new booking tends to be soft, and essentially Q3, quite often Q4 tends to be the best for new booking. So this is consistent with that. So Y&Y, there is still a growth. I think last year was 24 million, if I recall right, NN wins for Q1. We've done a little bit better than that. There were 3 deals, but I will kind of call out one that is the single largest one here. There is a company that administers the number of entrance exams and tests globally, global standardized tests that they administer in a number of countries. We are doing, at least 2 sets of services for them as part of this. One, we're doing F&A transformation, and we are bringing software development for multiple new products that they will bring to their customers. There are 2 other ones as well, both on infrastructure, one for a very large construction machinery company, and the other for a law firm. If you recall, our newly formed professional services vertical, one of the segments it addresses is legal. It was not a segment that we were addressing before. And so this is another example of success in that. Our employee metrics kind of stay range bound. Utilization, again remains stubbornly high. I can tell you right now, almost for sure that it will fall next quarter in a planned way. There's been a significant addition of freshers into the system in Q1. They will hit our utilization in Q2, but that's very planned and necessary for us to meet our demand through the year. While it may cause some quarterly variations, it is what we have planned to do for the year. Attrition, again, is range bound. we're quite happy with where it is. For those of you that are seeing chart 11, and I will give enough commentary for those that cannot, I'm going to spend some time on this. The headline, of course, is that from a geographic perspective, APAC led growth. Substantial growth in APAC, 24, 25% quarter on quarter. Remember, this is happening now after multiple such quarters. To a point where, in absolute terms, APAC and Europe are now, for this quarter, neck to neck. Europe, I have been saying that Europe will turn around and start giving smart growth. You're seeing it here. North America, we think it's a bit of an aberration. We've had solid growth in North America, slightly below company average, but only slightly below or higher than company average for a number of quarters. This is an aberration, so we will see North America back to good performance from next quarter. But there are, from a service line perspective, IMS continues to grow, be the fastest growing. And, this quarter, there is a large project where there's a good chunk of work that got completed. In fact, a little bit ahead of schedule. That's the reason why our revenues also did better, which is the reason for GTT to grow the best. But I want to call out something on this slide. Last year, we had said in August at the investor meet that we have 3 areas to fix. 2 problem areas and 1 potential future problem area. The 2 problem areas, one was enterprise services. Enterprise services was contracting roughly 2% a year for 3 years. And we said we brought in new leadership, we brought in a number of changes, and we said you should start seeing growth. So here you're seeing enterprise services growing Q and Q above company average at 4.7, and also showing actually a modest Y&Y growth. And so you will actually potentially see improved Y&Y growth in future. We've certainly turned the corner. The second thing we said was that MNC was growing at half the company average roughly, while you couldn't see that data because it was combined with PS vertical. We've now split out MNC and PS. I'll talk about PS in a second. MNC you're seeing actually now has the second fastest growth for the quarter, but in absolute terms, absolutely robust growth for the quarter. I'd said success will be if MNC starts growing around company average, but they've already started doing better. We said we will start providing breakout for PS as a vertical from this quarter and also provide you back data. So our press release has back data for a few quarters.
Total
5. So we provided data for a total of 5 quarters, this one and back quarters for 4. So you will see what it was before. I had said that PS would start showing, would start becoming flat this quarter and start showing Q and Q growth from next quarter and Y&Y growth in a few quarters down the line. I think we are slightly behind schedule we should have got to flattish. We're slightly behind schedule, but we fully expect to show Q and Q growth from Q2 onwards. That's actually it about the commentary on the various service lines and geos and horizontals. With that, I'm going to turn over to Rajesh for an update on some more on financials.
Thank you, Keech. Let's start with the financial update. As you know, we have our dollar revenue was 3.9% QOQ growth. Revenue growth was 3.9% QOQ and 12.1% YOY. CC revenue is grown by 3.3% QOQ and 10.1% YOY. And rupee revenue grew Q1Q 4.4% and 9.2% YOY. If you look at slide 14 on outstanding hedge position and rates, we have a hedge of 202.39 million, and the USD INR average rate is 70 rupees, Euro INR 84.51, and GBP INR 94.18. With the forex gain loss forecast, I think Q2 18 we will have $1.5 million income and forex gain, or Q3 18 we will have 1.6 million forex gain at an exchange rate of 65.175 per USD. And the balance sheet updates, good news is cash and cash equivalent has grown to 94 million, in rupee terms 6129 million. DSO is 74 days with unbilled, and without unbilled it is 47 days. And dividend we have declared is 1 rupee, which is 50%. And the capital, and we are committing that we'll give you a capital return of INR 8 per share for the year. Dividend payout including taxes will be 357.9 million. Tax ETR, as Keith said, is 20% this quarter versus 23% last quarter, and underlying was 20.5%. So our ETR is likely to stabilize at 20 and 20.5, between 10, 20 and 20.5. CapEx for the quarter was 1.7 million, and CapEx for full 2018 will be 17.5 million. I think with that, I will.
With that, we will do question
Answer session.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Good evening. Hi, thanks for taking my question. Keith, my first question, with the stronger quarter coming up next 2 quarters, as you mentioned earlier, a very modest ask rate, why would you not be upping the guidance? I mean, is there not a upside risk to that?
Listen, first is that, if we were to up the guidance, I would prefer to do it after 2 quarters, if you were to change it. So I just don't feel like we have enough certainty at this point to make a change.
Okay. And also, if you can throw some light of what's driving growth in Europe, and maybe in terms of verticals or service lines.
Sure. So actually, Europe, just across the board, around the world for us, one big shift that's been happening over the last 12 months is that our EN deals are becoming more material. And that's happening as a consequence of 3 factors. Our capabilities have expanded, our service lines have expanded, so there's more for clients to consume from us. Our customers have gotten around to finally recognizing it. Not everyone, but a number of them. And then our account teams have become better or have been changed, and they're able to take that message effectively. And, that is actually the best evidence of that is in Europe, actually. There's not one account or one deal that's driving growth. It's very secular. There is any number of accounts that are growing in Europe. There is one vertical, though, that is particularly growing better than the rest, which is H&I in Europe.
Got that. All right. Thanks and all the best.
Thank you. The next question is from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
Sir, we said earlier that 2Q and 3Q usually are strong quarters. So last year we did 5% kind of growth in constant currency in 2Q. So that kind of momentum will be there in 2Q and 3Q this year?
I'm not giving any more specific guidance than what we've already put out.
Okay, but we retain the commentary that earlier we said that 2Q, 3Q would be our best quarters on growth.
Yeah, you see, because the calendar is a little better in Q2 than Q1. So, and there are deal build-ups from last year that will start giving us revenue from Q3, some even from Q4.
Okay. And just one more, sir, on the margin trajectory, I think that has, at least last 2 quarters, the margin trajectory has been softening. So I think there has been good headcount addition this quarter. So how should we see margins from here on over the next 3 quarters? Thanks.
So the guidance at the beginning of the year is that our EPS will be flat with revenue. There's no reason for us to change it at this point. And you will see some kind of lumpiness quarter to quarter. I did tell you we made some S&M investments early this year. We've also made, which is not fully reflected in these numbers, we've added a fair bit of headcount. It's not fully reflected from a utilization perspective, but you will see it definitely reduce utilization quite a bit next year. But that's all planned. Yeah. So I'm telling you right now, you will see it go down, but it will help us then fulfill demand effectively for the rest of the year.
Okay, sir. Thanks.
Yeah.
Thank you. The next question is on the line of Sandeep Shah from CIMB. Please go ahead.
Yeah, thanks for the opportunity. Keech, your comments regarding 2Q, 3Q seasonally strong also holds true for FY18 despite a good start for 1Q?
Yeah, again, I'm not giving any more specific guidance than what we already given, which is what the growth for the year is. But yes, calendar-wise, it is a little better. But see, we did some of the revenues in Q1, improved revenues in Q1 was as a result of better execution and earlier completion on a fixed price project, which some of it could have otherwise come in Q2. But with that color, Q2 will be better. Q2 is just like calendar-wise, it has whatever 4% more calendar days.
Okay. And second, Keech, in terms of any further client-specific issues outside the 2 accounts which we had last year?
No.
Okay. And a few things in terms of the deal flows and pipeline wins and the IT spend both in Europe and North America. Any update in terms of a Q1Q? Is it improving? Is it remaining stable, or any kind of a weakness or softness you are witnessing?
We certainly see no softness in pipeline. In fact, this is a year of a pipe. This is a time of the year when the pipeline tends to build. The closures tend to be slower, and then the latter half of the year it tends to reverse a little bit. Pipeline tends to unwind, and closures tend to improve. From a Y&Y perspective, you're seeing improvement in pipeline, both in NN, even more so in our existing clients. Actually, I called out 3 reasons for improvement in EN earlier. There is a 4th and an important one, which is the fact that we've added a number of solid clients in the last 3 years. A lot of them have, headroom for additional services to be sold. So it's a combination of all 4 that our EN pipeline is looking extremely robust.
Okay. And just in terms of services, can you give some color? Will you able to provide us a composition of a digital revenues, how it has been doing? What are your efforts to ramp up? And second, if you look at your BFS this quarter, which was a growth driver for last couple of years, it has been slightly sluggish. Any reason to call out?
There's, no particular reason for BFS. We still expect it to be, by the time the year is done, we expect it to be, at or above company average in terms of growth. I think there's going to be competition for who is the fastest, which is a very good thing for the company. Last couple of years, they've been solo without competition on being the fastest, but I think they're going to get some competition this year from both HNI and MNC, especially the way MNC started. So, but yeah, I still expect them to do quite well. Sorry, you had a... I think you had
in terms of digital revenues. Yes.
Digital revenues. So we don't report digital revenues. And I've said many times, I'll say it again, there is no consistency in what the industry calls as digital, so we think actually it's quite kind of meaningless to look at digital or report out anything called digital. On the other hand, we do keep calling out the fact that you can see in our performance, you can see how some of the themes are playing out. You can see IMS and BPS growing as a result of automation. You can see ADM growing as a result of customer experience transformation, largely, and agile. So you can see digital assurance growing, again, largely as a result of automation. So we'll point out to you, what themes mean growth or not growth in service lines. But I don't see ourselves kind of joining the bandwagon and saying this is my digital and that's growing so much faster.
Okay. But do you believe your pipeline built up gives you a confidence that the growth can be diversified beyond IMS and BPS going forward?
Yes. So actually, if you see our service line, if you look at our service line growth, our ADM business has been growing consistently as a third. So it's gone a little bit under the radar, but it has consistently delivered solid growth. This quarter it's not, but if you look at the last number of quarters, ADM you will see is right around company average growth or just shy of company average growth. That is very critical for our business because it is the largest chunk of our business. If it doesn't grow well, we will not do well. So there is already diversification. That's the point I'm making.
Thank you and all the best.
Thank you. The next question is from the line of Ashwin Mehta from Nomura. Please go ahead.
Hi, thanks for the opportunity. Keech, I had a few questions on the secondary mortgage space. In October 16, which was 3Q of FY16, you had talked about large transformational programs in this space, seeing a stepping down in outlay from in 2 years. So that means more like the end of this year. So is that still an expectation?
Yeah. So, Ashwin, if you had not brought it up, I was going to bring it up proactively for you because I know you had sent this question earlier. We couldn't address it because we were in silence period. You have a, long memory. Bit of a yes and no in that the specific program, big capital program will wind down slowly, but it's not going to be a cliff. It's going to wind down slowly. On the other hand, that is being more than amply replaced by newer programs. So much like any kind of capital situation in any account, some programs come to an end and other programs start. There is no reduction in budget at the client because this program is winding down. Like I said, it's not a cliff. Like most large programs, if it's intended to get over in 18, it will not. it will go at a minimum some quarters beyond, maybe even longer. But it is beginning to kind of slow down, but there's no reduction in budget as a consequence of that. There are enough other programs, and we continue to maintain a healthy market share in the account. So that means we continue to do well in the accounts.
Okay. Just a follow-up in terms of our exposure in BFSI, how big would be the mortgage exposure, and any impact that you see from rising interest rates there?
So in terms of exposure, we don't report on it, but I'll say it's substantial. It is at a point of, there was a time, like say 3-4 years ago, when I would say asset management was, by far way and above the largest. It still is the largest, but the gap is not so large anymore. In fact, they may be quite even. Because even in these accounts, it's not all mortgage. There is some asset management, capital markets play, even within those two accounts. In terms of impact, clearly what's going to happen is that the number of kind of new mortgage originations may get impacted. But these guys are 2 steps removed from it. There will be, some volume impact on their overall business, but they are 2 steps removed from being a direct correlation with. The more direct impact will be on primary mortgage originators. What they do is then, they buy from primary mortgage originators. Their core business is to securitize it, resell it as different grade investments to asset managers. So that business will not change substantially. But there will be some impact.
Fair enough. And just last, one small thing from Rajesh. Can you remind us on what would be the effective tax rate expectations for this year and the next?
I think this year we are expecting, tax ETR between 20 and 20.5. That's what I said.
Okay.
Next year we are not projecting at the moment.
Okay. Thank you, and all the best.
Thank you. The next question is from the line of Rahul Jain from Emkay Global. Please go ahead.
Yeah, hello, sir. And so we have said that we have reinvested strongly on S&M. As you said, you see good opportunity in the market. So where we see these trends in specific, and if you could explain where are we investing more from S&M? Is it in terms of more foot on ground or opening newer areas in terms of markets, your capabilities?
Yeah. So the S&M investment is kind of fairly, it's in a number of areas, right? If you start at leadership, on the back of 9 leaders that we added last year, we added a very senior hire this year, which I spoke about actually, I think in the Q4 call, Sandeep does. But he joined during this quarter, during Q1. We are localizing our continental Europe sales force. Traditionally it's been, we're diversifying it and localizing that team there. We will continue to kind of add capability in customer experience transformation. That's the unit that Sandeep came to lead. We will continue to invest and add capability there. And finally, as we are kind of adding new accounts, we need to invest in increased account management and delivery management. So it's a broad-based, I wouldn't call maybe 1 or 2 areas, but it's a fairly broad-based investment.
Okay. And secondly, we have recovered, some pain parts of the portfolio and have no major headwinds in the client portfolio as well. So in this light, should not we expect better growth for the total business overall, or should we see this in terms of general declining growth rate in the sector? Or maybe you can just say that what is the ideal target growth rate for business of our size given the opportunities and capability?
Our ideal, our desired growth rate is going to be in teens, and I recognize teens is a wide range. But that's multi-year desire. As far as this year is concerned, like I've already said a couple of times, we don't see enough at this point to change our guidance. So our guidance remains what it was.
Okay, so just a small thing on the same thing. So if this number which you have in mind of teens, which has a wide range, what was this number, let's say, 3 years ago, and how it has changed over the last 3 years?
See, actually, our last 3 years average has been right around teens. I mean, it has been in teens. It has been in mid-teens. And our desire is to see, and that's not even every year. I think we had a year of 15% or 15%, then we had a drop to about 9%, then we were back to almost 16%. But 3-year cumulative basis, it's been in mid-teens. And our desire as an organization is, how can we build a team that will deliver that kind of performance for a very, very long time.
Perfect. Thanks, and best of luck.
Thank you. The next question is from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
Sir, on the manufacturing and consumer, can you break up on what are the sub-verticals of competency for us? And second, APAC has been driving growth for the last 2-3 quarters, and the growth has been phenomenal. So which of the regions in APAC where the growth is coming from? Thanks.
Right. So manufacturing and consumer has 2 or 3 important clusters. It has process manufacturing. It has education. It has retail, telecom. It has some others too, but these are the more important ones.
Okay.
And APAC actually, India has been driving growth. Hong Kong, Singapore have been driving growth.
Okay, is it mostly the shrink IT team which is driving growth in APAC as well? And whether this higher growth in APAC is also impacting the margin trajectory of last 2 quarters?
The answer to the second one is no. It's actually cloud has been, there is one very large project that we are executing, which I spoke about earlier, that we completed a bigger chunk than we had planned to in Q1. That's on cloud. So actually, if you want to call out a single in the new teams, Cloudify everything is the team that's driving the single largest driver, then followed by automate everything.
Okay, sir, and just one last question, sir. I mean, if you see the larger peers, they're talking of a lot of investments in front-end digital services like design studios or user interface, customer experience transformation, etc. So within our verticals of focus, so how are we placed there, and how was the recent recruitment, how we can help leverage him to drive this business?
Right. So we've had UX design and tech capabilities surrounding that or downstream to that as part of our ADM business for the longest time. And the reason you're seeing ADM, 3-year average, the third fastest growing business is that. What Sandeep's meant to do is to elevate it one further level. The way we think about customer experience transformation, there are 2 themes that he will bring. The first one is the fact that, if you look at all of our industry, we are all organized along substantially similar looking service lines. it doesn't matter who the company is, right? But really to deliver true customer experience transformation, it needs services to be integrated from multiple of the traditional horizontals. And so our new teams, each of our new teams is also meant to be reflected in organizational structures that cut across the traditional horizontal boundaries. The second kind of new thing is to focus on new age user interfaces. We believe the way humans will interact with machines and businesses will change fairly decisively to conversational and visual and gesture as opposed to typing. It may still, even if it's typing, it's going to be conversational typing as opposed to structured inputs into a computer or an app. And kind of leading the change into that world. So what that means is UI, as we've known it in the past, will become rapidly irrelevant. UI means you had a great mobile app. I think UI in future, great UI will mean a conversational interface that can understand everything you say to it. So these are kind of two changes in focus area. The first is to integrate across horizontals, and the second is to focus on the new age user interfaces.
Okay, understood. Thanks.
Thank you. The next question is on the line of Abhishek Bhandari from Macquarie. Please go ahead.
Yeah, thanks for the opportunity. Good evening to the whole management team. Keech, I just had, one question. In the third quarter conference call of 2017, you had indicated that you're starting to hunt into the portfolio companies of bearings, to get new business. Can you share some update over there?
Actually, one of the deals we won this quarter is their portfolio.
Okay, that's good to hear. But in sense of, are they becoming incrementally important in your, hunting ground for new deals, or they are just one of the, avenues where you're going to source new deals?
I didn't quite catch the word. What important, incrementally or?
Yes, incrementally, is it going to become one of the most important focus area for you, or, this is just one of the new avenues which you are looking, into?
Yeah. No, I think incrementally it will become more important. It is not a, in terms of revenue to the company from that kind of channel, if you will, is a relatively small, it's not material today. But, they are becoming more ambitious. I think, this is kind of public domain information. They are currently raising north of $5 billion fund, a new fund. They're raising capital for it. And, that puts them in, there are not many funds of that size, right? So then the individual ticket sizes of the investment will also go up proportionately. So each company they invest in will become a potential target for us.
Sure. So is there any change in the sales structure, or are you going to use the existing sales structure only to, get more into this avenue?
We are not changing our sales structure. So, depending on the vertical or the geography that the portfolio is located in, that particular unit will deal with it.
Okay, sure. Thanks, and all the best for the year ahead.
Thank you. A reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1.
Well, thank you all so much. Oh, there is one question.
Yes, sir, there's one last question. From the line of Ashwin Mehta from Nomura. Please go ahead.
Hi, thanks for the opportunity. Just one small one. In terms of our earnings guidance of similar growth as last year, this is on constant currency, right? Or what is the currency assumption there?
So I just want to clarify our guidance is 10 to 12% on revenue and EPS. So it's not similar to last year. So we said our revenue growth and our EPS growth will be parallel. So that's the guidance. You can take it in from a currency perspective, you can take it how you want. The reason we're doing EPS is frankly, if the currency moves in one direction, our gross margin will improve and our forex gains will fall. If the currency moves in the other direction, our gross margins will fall and our forex gains will improve. And the way our hedging is, there's a very heavy hedging for the year. Right? Sensitivity to currency for the year is not going to be huge.
Okay. Okay, that's all from my side. Thanks.
Thank you. The next question is from the line of Jay Daniel from Entropy Advisors. Please go ahead.
Yeah, would it be right in saying that at the moment there is a near 1:1 linearity between staff to revenue, growth-wise?
More or less, and that is very consistent with what we want to do. Because I know where this question is going. If you're focusing on automation, how is it that there is no non-linearity? Is that your question?
Yeah, because you have a goal of mentioned in your annual report saying that half the work done, will be done by machines. You want to be the first company to get there.
Right.
So how will this play out on staff strength and margins and, linearity of revenues and stuff?
Sure. Our goal is that, is not to use automation as a mechanism to improve profitability, but instead as a mechanism to improve market share. In fact, we believe that trying to improve profitability using automation is an unsustainable strategy. Eventually, customers will want to take the money back.
Okay. And if I were to look at your verticals, actually, there are two companies. I mean, you have BFSI, which has been growing quite well over the last 2 to 3 years, but which has margins of just 12%, whereas the others have single-digit growth, but with margins of 20%. You're saying this year it will be more even-ended, the growth between verticals. So will it be the case in the current year? I mean, why is there such a big differential in margins between BFSI and the rest?
So there are actually a couple of accounts in BFSI where by law we need to do all the work onshore. So that's the reason for the difference in margins. And a lot of what you see as a total onshore business actually comes from BFS. Yes, this year we do expect more balanced growth.
So that will play out on better margins. I mean, that will give you better margins this year.
We've given a composite guidance on margins that we think it will be flat, essentially.
Okay. This decline in planned utilization, which you are stating, would it result in a decline in value add per employee for the year?
I'm not sure I understood the question. Will you say that again?
You have said from the next quarter there would be definitely a decline in utilization. It's going to be planned with addition of freshers into the company.
Right.
So would it result in a decline in value add per employee? Would it be too broad a statement to make?
Yeah, I'm not sure quite what you mean by value add per employee.
There is sales minus staff expenses on a per staff basis.
Yeah. Well, I mean, temporarily, if there are people sitting idle, then it will reduce it. It will. But, it's the same as saying utilization is lower, revenue per headcount will come down. Yes. But we expect it will be a temporary injection as we kind of look to manage our supply for demand better.
Okay. And, sir, nearly one-third of your capital employed is in cash, and nearly the entire amount is in current account. It hardly gets any return. In fact, there's no return on it.
Yeah, it's just to manage forex risk.
So our, around 60% money is in US, I think in dollar terms, where we are getting very low amount of interest. But then that's to, manage the forex risk across the world, we are keeping it money. And I think that's what it is. I mean,
we are rethinking about it, but historically, given the, currency attrition, there isn't a lot of value ultimately in moving the money, getting higher returns and losing it in currency. And then there is a risk. But we are rethinking about it.
So you're saying bulk of this money is lying abroad because you have a statement saying that whatever profits are there in subsidiaries will be reinvested there.
Yeah, profits we definitely reinvest, but I think a lot of money comes from through way of transfer pricing. So as and when money is in India, that money is transferred here.
But yes, the cash is in subsidiaries.
Yeah.
Okay. So that, nearly one-third of your capital employed doesn't earn any return now, as of now.
It doesn't earn any treasury income. Yes.
See, you have to evaluate between, earning treasury income or losing money on forex. That's what you have to evaluate at the end of the day.
Okay. And your capacity increase is largely driven by tax planning, right? SEZ requirements.
Yes, and headcount additions.
Yes.
And unfortunately, where we kind of have campus capacity doesn't always match with where we need additional people to be deployed. So there's some renting going on. So there's capacity expansion driven by both. This year, actually, there was none driven by SEZ. I think the SEZ requirements were completed when we built phase 2 in Chennai and the Pune campus. But that got done pretty much in, by early 2018.
That's right.
Since then, early 2017.
Middle of 2017.
Pune got completed early 2017. Chennai phase 2 got middle 2017. Since then, all the expansions have been basically driven by demand.
Okay, because most of the Chennai capacity, etc., only half is utilized, less than half is utilized.
Correct. So the Chennai capacity expansion was driven by SEZ.
Okay, and going forward, your capital investments will not be much.
So we've projected, we've given you 17.5 million for the year. That's right.
Okay. Thanks a lot. Thanks.
Thank you. We'll take the last question from the line of Sandeep Shah.
That's the last question.
CIMB. Please go ahead.
Yeah, just a follow-up. In most of your comments, you said that in verticals also this year, the growth may not be just from the capital markets or HNI. It could be GTT and MNC as well. In terms of services also, you also said that it won't be just IMS or BPO. It could be ADM and enterprise solution. And in terms of the new wins, you are also saying that the existing accounts, new wins are also ramping up. And in deal closure also, you are saying that there is no softness. But you still say that you are not getting confirmations to upgrade the guidance. So what kind of confirmations you are looking for? So how should we read this, connecting the two facts?
Yeah, sorry, I just want one quick clarification. I didn't say GTT in terms of competing for top spot and growth. I said, I didn't say GTT, I didn't say professional services. But I did say HNI and MNC could compete with BFS or the top slot in growth. We look at a variety of things, Sandeep, and I just kind of, this is what we did last year too. We looked at 2 quarters, of solid actual performance before we think out of the guidance. And so I don't feel kind of good about doing anything basis one quarter.
Okay. So your assumption of budgeting or giving a guidance has not changed post the 4Q and now post 1Q, right?
I'm not sure I understood the question.
No, when you budget to give the guidance, when you have given the original guidance post 4Q, and now when you foresee, your assumptions have not majorly deviated, right?
Correct.
Okay. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. R. Srikrishna for closing comments. Thank you, and over to you, sir.
Well, thank you all for your patience for a late evening call. I look forward to talking to all of you next quarter and maybe meeting some of you perhaps in between. Thanks. Have a good evening.